In 2025, stablecoins processed $46 trillion in transaction volume. To put that in perspective, PayPal processed around $1.7 trillion that same year. Visa processed around $16 trillion. Stablecoins did more than 20 times PayPal and nearly 3 times Visa. And most people have never even heard of them. As of April 2026, the stablecoin market has hit $319 billion. The U.S. government has passed the Genius Act, the first major law specifically regulating them. Banks are launching their own, and they are rapidly becoming the digital infrastructure for how money moves around the world. Today, Coin Explained breaks down exactly what stablecoins are, how they work, who the major players are, what the new regulation means, and why they matter to anyone who uses money. What is a stablecoin, and why does it need to exist? To understand why stablecoins exist, you need to understand the main problem with most cryptocurrencies. Bitcoin can gain or lose 20% of its value in a single day. Ethereum has swung 40% in a week. That kind of volatility makes regular crypto exciting for speculation, but completely impractical for everyday use. If you agree to sell something for 1 Bitcoin today, and by the time the buyer pays you it has dropped 30%, you have just lost money on the deal. Stablecoins solve that problem. A stablecoin is a cryptocurrency that is designed to maintain a stable value, almost always pegged to $1. 1 USDT is always meant to equal $1. 1 USDC is always meant to equal $1. The price does not go crazy. That is the entire point. This stability makes stablecoins genuinely useful for things that volatile crypto cannot do. Paying for goods and services, sending money internationally without exchange rate risk, keeping money in a digital wallet without watching it lose value, settling financial contracts between institutions, and increasingly, replacing the traditional banking infrastructure for cross-border payments entirely. Think of stablecoins as the best of both worlds. They run on blockchain, which means they are fast, borderless, programmable, and available 24 hours a day. But they hold the value of a regular dollar, which means they are practical, predictable, and safe to use for everyday transactions. That combination is why the numbers are so extraordinary, and why governments around the world are suddenly paying very close attention. Not all stablecoins work the same way. There are 3 main types, and understanding the differences matters because they carry very different levels of risk. Type 1, fiat-backed stablecoins. These are the simplest and most widely used. For every stablecoin in circulation, the issuer holds $1 or a dollar equivalent asset like a U.S. Treasury bond in reserve. You give the issuer $1, they give you 1 token. You give the token back, they give you $1. USDT and USDC work this way. They are essentially digital receipts for real dollars held in a bank or treasury account. Type 2, crypto-backed stablecoins. These are backed by other cryptocurrencies rather than dollars. Because crypto is volatile, they are typically over-collateralized. You might need to lock up $150 in Ethereum to mint $100 worth of stablecoin. The extra collateral acts as a buffer against price swings. DII, now rebranded as USDS, works this way. It is more decentralized than fiat-backed stablecoins because no single company holds the reserves. Type 3, algorithmic stablecoins. These attempt to maintain their peg using software algorithms that automatically adjust the supply of the stablecoin in response to demand. No reserves required. This sounds elegant but has proven to be extremely risky in practice. The most famous collapse was Terra UST in 2022, an algorithmic stablecoin that lost its peg and wiped out approximately $40 billion in value in less than a week. After that collapse, algorithmic stablecoins have lost significant credibility and market share. The Genius Act does not permit purely algorithmic stablecoins to be issued under its framework. The stablecoin market is dominated by two players, and understanding the difference between them matters if you are going to use either one. USDT, Tether, is the largest stablecoin in the world with $189.6 billion in circulation as of April 2026. It has been around since 2014 and is the dominant stablecoin for trading on exchanges and for cross-border payments in emerging markets. USDT is especially dominant in regions like Southeast Asia, Latin America, and Africa, where it serves as a practical dollar substitute for people without easy access to the U.S. banking system. However, Tether has faced ongoing questions about the quality and transparency of its reserves. Its audits have been conducted by smaller, less well-known firms, and under the Genius Act, as a foreign issuer operating from El Salvador, Tether faces regulatory uncertainty in the U.S. market. As of May 2026, the U.S. Treasury has not yet granted the reciprocity determination Tether needs to continue operating for U.S. businesses under the new law. USDC, Circle, is the second largest at $77.6 billion and is widely seen as the more regulated, transparent alternative. USDC is now attested by Deloitte, one of the world's largest accounting firms, and is regulated across more than 20 blockchain networks. On December 12, 2025, the U.S. Office of the Comptroller of the Currency granted Circle conditional approval for a national bank charter, making it the first stablecoin issuer to receive federal banking status in the United States. In simple terms, USDT is bigger and more globally dominant. USDC is more regulated and more trusted by institutions. As regulation tightens under the Genius Act, the gap between the two is likely to narrow, or shift. The Genius Act, the Guiding and Establishing National Innovation for U.S. Stablecoins Act, was signed into law in July 2025. It is the most significant piece of crypto legislation ever passed in the United States, and it changes everything about how stablecoins operate. Before the Genius Act, stablecoins existed in a regulatory gray area. Tether and Circle operated largely outside the traditional banking system with limited oversight. This created risk for users. If a large stablecoin issuer failed or was found to be misrepresenting its reserves, there was limited protection. The Genius Act changes that. It requires every regulated stablecoin issuer to maintain one-to-one reserves. For every token issued, $1 or dollar equivalent must be held in reserve. It requires regular audits by qualified accounting firms. It allows banks and financial institutions to issue their own stablecoins, and several U.S. regional banks have already applied for stablecoin charters under the new law. The practical effect for everyday users is significant. Regulated stablecoins are now comparable to a money market fund, an audited, backed, legally recognized financial instrument rather than a product operating in the shadows. There is also a geopolitical dimension. Because nearly all stablecoins are dollar-denominated, every stablecoin transaction is effectively a dollar transaction. USDT and USDC combined now hold $149 billion in U.S. Treasury bonds, making stablecoin issuers the 18th largest external holder of U.S. government debt in the world, ahead of Norway, South Korea, and the UAE. The more stablecoins grow, the more demand there is for U.S. dollars globally, which directly serves American geopolitical interests at a time when de-dollarization is a real concern. Here is where stablecoins move from being an interesting financial concept to something with real, immediate impact on people's lives. Cross-border remittances are one of the most powerful examples. When a worker in the United States wants to send money to their family in the Philippines or Nigeria, the traditional process involves bank fees, exchange rate costs, and delays of several days. A stablecoin transfer takes seconds, costs a fraction of a cent, and is available any time of day or night. For the estimated 1.7 billion people in the world who are unbanked, who have no access to traditional financial services, a stablecoin wallet on a smartphone is their first ever access to a stable store of value in a global payment network. In business, stablecoins are increasingly being used for supplier payments and corporate treasury management, particularly for companies operating across multiple currencies. Instead of navigating slow, expensive bank transfers and currency conversions, businesses send stablecoins instantly and convert to local currency at the destination. And on a systemic level, stablecoins are beginning to replace traditional correspondent banking, the network of banks that currently handle international transfers. Ethereum's transaction volumes for stablecoins rose 50% after the Genius Act was signed. JP Morgan uses a permissioned stablecoin for wholesale institutional settlement. BNP Paribas joined European stablecoin infrastructure. The pipes of global finance are being quietly rebuilt around stablecoin rails. The stablecoin is not just a crypto product for traders. It is becoming the plumbing of the new financial system. A stablecoin is cryptocurrency that holds a steady value, usually $1. It combines the speed and programmability of blockchain with the predictability of regular money. $319 billion in circulation, $46 trillion in transaction volume in 2025, the first major U.S. law regulating them, banks launching their own, the infrastructure of global payments being rebuilt around them. Hit subscribe and turn on the bell. Next week on Coin Explained, DeFi. What is decentralized finance? How does it work? And how can you access it? See you there.